What's going on, guys? Welcome back to the channel. In this video here, we're going to be taking a look at Facebook. Now, I covered this company not too long ago, but since recent news of this company has been getting bashed and bashed and bashed, the price has been decreasing pretty much for quite some time. We've seen a massive fall off over here. This is the stock research tool built by yours truly. Look at this price drop, guys. And it's been hovering in this 190 to 200 range for quite some time. Now, I wanted to investigate this company once again because here's the thing, folks. Day over day, we're going to hear a lot of negative news about tech stocks. We're going to hear a lot of news that, well, with interest rates rising and these FANG companies and Facebook being the F in the FANG companies, they're going to start falling. Everything's going to start to essentially crumble in the words of the media. Now, as an investor, you should be excited about this noise. This is all this noise because if your outlook is 10 years down the line, this is just going to be a little blip. These days here where we're seeing these decreases in price for God knows what reason, fear, earnings that may have been missed. This is a company that has a stronghold on the social media space. Their apps, Instagram, WhatsApp, and of course Facebook. Most people have one of these apps, if not all three. Their cornerstone is pretty much they have almost the entire world locked into one of their platforms. 1 in 3 people, that's the number, folks. 1 in 3 people have a Meta Platforms app. Down in the line, we're going to have the metaverse come out. This is a strong business. However, you have the media pushing this negative news, getting people scared, getting investors scared. Why? And people are falling for it. But you're smarter than that. You know what's going on. We are ranking this business a 9 out of 10, folks. And what this software does, it takes a look at the income statement, the balance sheet, as well as the cash flow statements, and grades it out of 10 different categories. 9 out of 10 is a phenomenal score. We're only losing a point in one category, and that's our PE 5-year average. That's 26.58. We want to see this number underneath 22.5. In a trailing 12 months category, as we can see here in our company metrics category, it's sitting at 13.92. It's low. It's in our ballpark. This company is doing a lot right. With a current ratio sitting above our 1.5 threshold at 2.81, it has enough assets on hand to cover their liabilities. Return on equity is 24%. We want to see this over 15%, and we have that. Even in a trailing 12 months category, we have that at 28. Huge EPS growth. Phenomenal debt to equity ratio, sitting at only 10%. 10%, folks. We want to see this number underneath 50%. That means they're growing the business through equity, not through debt. Creditors don't have a stronghold on this business. And as interest rates rise and these companies are unable to borrow money as much or easily, it's comforting to know going forward that this company can take on any kind of growth just from within the business. So, share dilution, they're buying back shares, folks. 1% decrease over the last 5 years. Not a huge decrease, but a decrease nonetheless. It's great. We want to see this number staying the same or better yet, decreasing, and we have that. Growth in our net income, free cash flow, and revenue growth is up. Our return on invested capital average is 25.56. Huge numbers. We want to see this over 10%, and we have that. No problem. Even in our trailing 12 months, we're currently sitting at 30.67. Jump down here to the free cash flow statement, guys, and take a look at this. Facebook, year over year, 2014, just climbing. But yet the stock price is down. Stock price is down to pretty much, well, 2020 levels after the crash. the COVID crash. We're pretty much just before COVID levels, essentially, but we're seeing a massive increase. We're seeing a massive increase in revenue, free cash flow, so on and so forth. And look at that, guys. Look at this revenue. Just consistent. Consistent. But yet the news is going to be bashing this company. And see, this is why I don't watch the news. I don't watch the news for this reason. Because there's going to be a lot of noise. I look at my app here, investigate the business. Do these 3 statements make sense to me? And then I go from there. There's a lot to appreciate with Meta. And if you're an investor and if you're buying this company or you're holding this company and afraid of what's happening next, you shouldn't be. You should be excited that this price is falling down. It allows you to buy this cheaper. Full disclosure, I have a position in Meta. And guess what? This price here, I'm going to be buying more. We'll do a price analysis, folks, on this company, and we'll investigate what a fair price to pay for this company will be. Okay, so folks, here's what I did. And if you're enjoying the video so far, folks, hit that like button, hit the subscribe button. This app here will be available to you. If my camera could stay in focus for just like 2 seconds. If it could just stay in focus for just a second, that'd be much appreciated. If you're enjoying the video so far, folks, hit the like button, hit the subscribe button. It means a lot to me, it means a lot to the channel. Now, I'll show you what I did here with my price analysis. I'm looking at the revenue growth. I'm looking at the numbers that we have here, 37%, 33, 42, huge numbers. And I'm deciding to be conservative. I've decided to use 10, 12, and 14%, extremely low numbers. Profit margin, keeping it roughly the same with a slight trim off the top. Free cash flow margin, same thing, just a trim off the top. Price to free cash flow going 14, 16, and 18. And a PE ratio, currently sitting at 13.92. I'm putting a low PE ratio, guys. A super low PE ratio, doing over a 10-year valuation. And this is not even trying to factor in the metaverse of what's to come. This is just what I think the company might do, given its current state, over the next 10 years. Put our desired return in 13%. Take a look at this, guys. Average calculation comes out to be 344.26. We're currently sitting at 190.78. Conservative average, $241. We're assuming an incredibly low PE ratio, folks. Take a look at that. Low revenue growth. Now, I could make these numbers reflect what we currently have here, but I'm being conservative. I have to be conservative. I want to give myself a decent margin of safety, and we're checking off all of these boxes here. So here's what I mean. When you have to build an investor mindset, strong investor mindset, you can't get distracted with the blips of the news. I'm going 10 years down the line. 10 years. 10 years from now, I will reevaluate this company. But right now, based off these numbers here, based off the current fundamentals, based off the revenue growth, it only makes sense. To me, it's a buy, and I'm invested in this company. I put money, I have skin in the game. Now, does that mean you should go out and buy this company because I did? No. You have to do more research. You have to do your own due diligence. There's a lot of things to look at. The management team. What do they have in the pipeline? I've done all this, and I think it's worth it. Now, if you think it's worth it, go for it. This is the numerics I think, and I believe it's wholeheartedly undervalued. It's going to be very hard for any other company to compete with this business. The only drawback I see with this company is that they won't be able to grow as quickly in the future. But I factor that in. I factor that in with a low revenue growth, a third of what they've been doing. So I'm covering that base as well. Anyways, folks, if you enjoyed this video, hit the like button, subscribe button, and comment down below of a company you want to see evaluated. Ignore the noise, folks. Ignore the noise. As prices start decreasing, and you'll see this a lot with a lot of companies, as interest rates rise and we start hitting the potential recession, and this market eventually starts coming down from the bubble that we're currently in, it's going to be very excited for the value investors. A lot of people are going to get wiped out without a process, but what I'm trying to do here on this channel is to try to approach this as rational as possible. Try to approach this with a margin of safety. Analyze the numbers and see what makes sense. The numbers don't lie. The only thing that will hold us back is our own human emotions. So, best of luck to everybody that's involved. I'll see you in the next video. Thank you so much for watching.